Several big earnings coming up this week. Some of these stocks are poised to move quite a lot, including Carvana, and we're going to talk about that right now on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic at an off hour. We are doing this because I'm actually going to be appearing on Fast Money for the full hour later today between 5 and 6, and that was just going to be packing it in a bit too tight. So one of the things I wanted to talk about today is one of the stocks within the Russell 1000 that, at least according to the options market, is poised to have one of the largest implied moves following earnings, and that's Carvana. So Carvana is an interesting story. This is a company that was founded by the son of a used car dealer from Arizona. He went to Stanford. He ended up working in finance for a number of years. Probably many of you viewers are familiar with the company. Their whole premise is effectively to create a used car buying experience without the used car salesman. So they're focusing on things like transparency and ease. They'll actually pick cars up that you are going to trade in, deliver cars that you buy. They have these vending machines. Perhaps you've seen those. There's only a handful of them, but they had one in Austin. And in fact, I've actually used Carvana. When we were leaving Austin to move back to the San Francisco Bay Area, I ended up selling a car to Carvana that we were no longer going to need. And from a customer's perspective, the experience has been quite extraordinary. And so that got them a lot of buzz. I think these vending machines, which basically are these glass towers with multiple layers of cars in them, also got them some attention. But there are a lot of dynamics at play in the car business right now, and actually over the course of the last several years. So if we go back to the period right before the pandemic, there was obviously a glut of new cars on lots leading into that. That was going to create some pressure on used car prices, of course. Once the pandemic shutdowns went into effect, that severely constrained the supply of new cars. And the consequence of that was that demand for used cars shot up enormously. And that was a huge benefit, of course, to Carvana. At the exact same moment that that was going on, so this was going to increase the demand to purchase cars, it was going to increase the value of the inventory that they had, and at the exact same moment, we obviously saw interest rates go effectively to zero, which is highly supportive. Add to that the fact that there were a lot of transfer payments, benefits being paid to people, direct payments being deposited into folks' bank accounts, so they were flush, and that essentially was an enormous benefit. Fast forward, manufacturers come back online, interest rates rise, pandemic benefits run out, and the exact opposite happened. So what was going on here? So very interestingly, from the pandemic plunge low in March to Carvana's all-time high, the stock appreciated by about 1,600%, believe it or not. And that was after falling about 80% into the pandemic plunge. When interest rates rose, when the used car market began to soften, when the new car lots started to fill back up again with manufacturing, and as the pandemic benefits ran out, the stock fell almost 99%. And it fell almost 99% because as a startup, they just had massive amounts of spending. The company was not profitable, had massive negative free cash flow, and they were essentially trying to just focus on growth. And of course, they were wearing the overhead of a lot of the inventory of used cars that they had purchased. So used car inventory values were dropping, the demand for the cars was dropping, basically a perfect storm. Nearly 99% decline in the stock price. As it sat on the verge of bankruptcy, the management decided to focus more on essentially their operations, cash flow, net income, that kind of thing. Astonishingly, from that near-death experience, the stock then recovered by 3,400%. So that low actually was well below the pandemic plunge low. The thing was trading down to low single digits, I think, at one point. And here we are. Now the stock is in the, it's over $100 again. So let's just take a quick peek. I'll just pull it up here on this right here. So we're going to take a quick peek now at what's going on. So here's a chart of it over the course of the last year. I'm just going to bump this back just so we can take a look at this rather wild ride that it's taken. I'm going to go back 5 years. At first, okay, being told to hold on 1 second, so I'm going to. All right, so here we go. So this is that wild ride that I was talking about. And actually, the moves were so pronounced that actually looking at this chart, it's almost hard to, you'd actually need to look at slices of it to properly appreciate the magnitude of the moves that we have seen. So like I said, a near 80% decline over here on the left during the pandemic plunge, a 1,600% rally up to the stock's all-time highs, which were back in August of 2021, before falling nearly 99%, almost to the verge of bankruptcy, a lows of $3.55. This was back at the tail end of 2022. You can see it hit $3.55, and it has subsequently rallied back. Actually, it got to close to, I think, $150 or so. So that was a 34-bagger, if you can believe that. So let's also now take a quick peek at the financials for this one, because I think they tell a rather interesting story. So if we go back in time a little bit, one of the things we're going to see here is just the magnitude of the cash flow losses that the company was incurring at the time. So about $1 billion in 2019, another billion, round numbers now, 2020, over $3 billion in 2021, close to $2 billion in 2022. That situation has subsequently seemed to have righted itself somewhat, almost unbelievably, it should be said. And the net debt for this business right now is about again, round numbers, $6 billion. So when we think about the free cash flow to debt levels, or maybe we just want to take a look at EBITDA to debt, these are some pretty rich multiples. I mean, if you think that it's got about $6 billion in debt and it's generating about $600 million in EBITDA before, up through the last 12 months, this is a heavily levered business. And so right now, the options market is implying, this was of the Russell 1000 stocks that are reporting this week, this is the stock that had the highest implied move, nearly 18%. So the question is, what do we think about it? Now, I have to say, I feel that this is a difficult situation right now for this business. And I'm basing that on a couple of things, some of which I've mentioned on several occasions recently, which is we are seeing increases in auto loan delinquencies. We are basically saying that the consumer is quite stretched. Add to that these higher interest rates, and it's really a problem in terms of affordability. So new car prices, which peaked out at, I think, just under $48,000 on average, which is a remarkable number all its own. They've fallen back a little bit, but they're still above $47,000. So new cars are not particularly affordable. We are beginning to see some manufacturer incentives. We are beginning to see buildup of inventory on dealer lots. In fact, new car dealer inventory, from my understanding of the most recent data I've seen, actually exceeded 3 million cars. That is the first time that that's been true since pre-pandemic, December of 2019, which also represented a relative glut. And you combine those things with, there's still a little bit of a shortage on the used car side, which is where they play. But the fact is that, dealers in general, and they are a car dealer, a big portion of the, what helps smooth their revenues and smooth their net income are other areas, including parts and service. Carvana is focusing primarily on the sales aspect. I think that puts them in a slightly more vulnerable position. Combine that with the fact that the stock is not particularly cheap here. So if we take a look, for example, at full year 2025, the street consensus is that this is a company that's going to earn adjusted EPS of about 20 cents a share. It's trading $126 a share right now. And of course, the used car business can be very lucrative. That's all good. You go out to 2026 and the street's looking for $1.73. Still, you're talking about multiples that are extremely, extremely high. And this for a business that is demonstrably and historically quite volatile and vulnerable to economic weakness. So what do I think we ought to be taking a look at here? If you haven't gathered it already, my inclination is that this run that we've seen is probably closer to finish than just beginning. I don't think that Carvana is going to regain those highs that we saw so recently. Again, I'm just going to pull this chart up so we can take one last look at that. This is a one-year chart, and I think I should probably push this back to 2021 so that we can see those all-time highs, just give it some perspective here. This is just a bit too ambitious from my point of view to think that it's going to, recover. And this is really one of those interesting things is that, if all you do is look at a chart and you don't look at the fundamentals of a business, and there is merit to that when you're going into short-term catalysts. In the short term, the market is a voting machine. In the long term, it's a weighing machine. I get that. But this is a situation where I think the valuation that it enjoyed back in 2021 was frankly just a bit silly. And I think it was a big Momo trade. People got on it. We're going to change the world kind of thing. This is not as transformative a business as some areas of AI are, for example. So while I think the used car business can be a good business, they've now demonstrated that they can run this thing even with its $6 billion in debt, that they can do so profitably. But do we think it's going to do so without any volatility, and do we think it's going to grow into the valuation that it currently implies? I think that's a tough one. So what to do? Well, I'm going to just throw up the term structure here so we get a view of what the implied volatility is going out through time. Now, as I pointed out, and I'm just going to focus now not on where it was, which was the line in red. I'm just going to focus instead on what we're looking at right now. And as you can see, the near-dated options are extraordinarily expensive. How expensive? Well, let's take a look. So, like I said, they're going to be reporting this week. They're going to be reporting the day after tomorrow. And the at-the-money straddle expiring at the end of this week. So that's the 126 straddle. As I look at it right now, is priced at about $23. $23, very nearly 20% of the stock price. So I think we have these two sort of conflicting aspects. We've got this fundamental picture, which I don't think looks that great in the longer term. And we can combine that with the fact that the stock had been doing reasonably well up until recently, and it seems to have weakened pretty considerably. We can sort of see that now. The stock's down 5%-ish or whatever as we speak. So what to do? I think you can take a bearish bet, this is a stock, actually I should just double check here. Let's just take a quick peek, one last point of interest before we get to how to affect one. High short interest. Not the highest I've ever seen, but we're talking about 17% of the float. And part of that is almost certainly a function of the open interest on the put side, which, if you can see my screen, probably hard to read. But the sentiment overall in the options market, I don't think we could suggest that it's that positive. When you see a situation where the put open interest is significantly higher than the call open interest, that's not generally the case. Let's just take a quick peek at another company that's reporting. I haven't even checked this, but I'm just going to assume that this is true. Microsoft's also reporting this week. But usually the call open interest is higher, and sure enough it is. Meta is also reporting. Meta, by the way, is another interesting one we should probably think about, because that one has had some big moves later. Once again, 1.2 open interest on the call side versus 870,000 on the put side. So that's a more conventional thing for single stocks. In ETFs are very commonly used as hedging. You see a lot more skew there. That's we can take a look at SPY, for example. That could very easily have more put open interest than it does call open interest, and sure enough, there we have 11.7 million versus 5 million. Again, I'm just going to use round numbers, but I'm just trying to demonstrate the point. So Carvana, unlike most single stocks, the put open interest is higher than the call open interest, and what that means is that a portion of that short interest that you're seeing is very likely coming from the market makers, the market making community. So people go out, they buy puts, the market makers have to sell by selling stock, hedge by selling stock, and I think that's what we're seeing here, in part, at very least. Remember, it's 370,000 open interest. Not all, those things assume some delta on average for that, and you can sort of get a sense of what that is. So that would be 370,000 puts is 37 million shares worth. Use a 30 delta as your average for what those puts are. That gets you to 10 million shares, and that's assuming that all of the customer side is long puts, which won't necessarily be the case. So you can start ratcheting that down. But all we're trying to do is just get a general lay of the land. How short might the market making community be? And then of course there's the call side, so they're going to have some offsetting deltas there. But it helps give us some perspective. So I think taking a longer term bearish bet on Carvana probably makes some sense. Just not a business I'm really enamored of. But you're not going to, and we could get a very big move out of earnings. Make no mistake, options market's implying a 20% move, and we could easily get it. But we might not. And so I think that it probably makes some sense to consider putting on either a straight downside put calendar or a put diagonal, buying longer dated puts in Carvana, just playing for the big run that we've seen to stall out and possibly roll over. You definitely want to go past September. I think we could see additional volatility in September and October, even ignoring contributing factors such as the election and so on. So, a way that one could do this, interesting. OptionPlay just sort of defaults to, has a bullish view on it technically. Obviously I do not. And actually, you know what? Let's just quickly, before we get to that, let's just take a look at what the, an array of technical indicators might say. How many of these are bullish? How many of these are bearish? So right here. So that's interesting. Short term, a lot of the technical indicators, now some of these, such as trading envelopes, RSI, and Bollinger Bands, there's no position based on the parameters that the Bloomberg technical studies default to here. So those aren't bullish or bearish. That means that they have either closed a long or closed a short position, but those technical indicators aren't indicating anything right now. And actually, we can probably see that if we go to RSI, it's probably dead bang in the middle. Let's take a peek. Sure enough, there it is. You know what? I'm sorry. I just, you might not be used to that chart, so I just blew into it really quickly and wasn't wasn't really sharing. So let me just spend a little bit more time so you guys can see what it is I was actually looking at there. So this is RSI right here, right? So you initiate a buy position when it goes below the green, you initiate a sell position when it goes above the red, and you can see that right here we're just dead bang in the middle, no position. Okay, so let's just get back now to how one might structure it, how you might choose your strikes. The implied move is understandable given how big the moves have been. That's usually my starting point, is that I will target the implied move to the downside. So, if you're looking at 17, 18%, somewhat astonishingly, what you're dealing with then is going to be somewhere around the 100 strike, believe it or not. By the way, on trades like this, be sure to use limit orders because, you're just dealing with something that really moves, and you're probably going to have some slippage if you're not careful. So take a look at the mid-market price. I will typically look at the mid-market price and then sort of try to get my bearings to see whether either of the two options, if it's a two-legged spread, are well away from where I think they ought to be priced. Get to some reasonable estimate of what I think the fair value for those legs are. I'll usually start, in this case, you're going to be a buyer because you're buying a calendar spread, bid slightly below the midpoint and then walk the trade up. What do I mean by walk it up? You start with a limit order. If you think, for sure, I think a marketable limit order on a spread, in this case, the mid price is on this one, 1537 that I'm looking at here. This is not the trade we're going to settle on. I'm just using this as an example. But the Carvana August 16, SEP 20, 100, 130 put diagonal. So in this case, this would be buying the September 130 puts, selling the August 100s. Mid-market price, at least as implied here, is $15. You could start at 15 and then just walk it up by a dime or 15 cents or 20 cents, depending on the prices. Some things, you can trade in dimes, some things you can trade in nickels, some things you can trade in pennies, depending. But then you just walk it up and just pause a little bit and wait to see if it goes, because the algorithms don't necessarily hit the immediately marketable order straight away. Sometimes you do need to have a little bit of patience, or depend a little bit on the stock just moving around. If the stock is just sort of range bound throughout the day, you can stick one of these things out there at what you think is a fair price. More often than not, it'll go off, and then of course if it starts to get away from you, you can get more aggressive. Just something to think about there. Okay, so I would like, though, to go a little bit further out in time, potentially capturing the next potential catalyst. And I don't think it's a problem, by the way, to trade a straight calendar in this case. So doing something like this, you're going to bring the cost of the trade way down when you do that. Now, of course, the downside of this, as this P&L will illustrate, is that if the stock moves meaningfully below the implied move to the downside, you're actually going to go from a range of profitability down to an area where it no longer is. So that's the advantage of doing a diagonal. You lay out more money, but, and let's, very quickly I'll demonstrate that. So I'm just going to, a diagonal being one where you get long, for example. If you watch this, I'm going to just watch that P&L chart over there. Notice how the left tail is rising like that. So what's happening is you're getting to a region where you can actually, if it was the 130, 100, you're going to spend less than $30 on that spread. So it could be profitable at any point to the downside. But of course, you're laying out considerably more premium. So if the stock goes the other way, that's going to work against you. So those are the kinds of trade-offs that you want to think about. I think, just a narrow diagonal, something like that, or even a straight diagonal, which would be something like this, is probably fine, because what we're talking about here is the probability that the stock drops below, in this case, Now, is this, by the way, when you look at these break-evens, bear in mind that you ought to be thinking a little bit about what the volatility prediction is post-earnings. So we can expect a little bit of that November vol crush to come in. That's not necessarily accounted for here. So this should just use this chart as much as anything as a general guideline for how the trade is likely to behave. And then you can go in and make your own adjustments if you want. So how do you do that? You can go in here, and this is actually, I don't think I've ever demonstrated this. But one of the things you can do here is start modifying some of your assumptions. So you can broaden out the trading range, and you can actually do it just by toggling that little radio button, or you can actually drag these things out like this. And that trading range is really what is your sort of volatility forecast, if you will. And you can adjust the expiration. You can manually put these things in here. I think that's something else that if you're using the app, this app, or any app, frankly, those are the things that are going to impact the profitability for a trade like this. So enough about Carvana. Two other quick things that I think are coming up, and I'm probably going to be talking about these later today, so I might as well just mention them now, I guess. Meta and Microsoft both going to be reporting. So let's take a look at these in turn. Microsoft is not implying a very big move. I think about 4.7% as I was looking at it. This stock has been sort of in a prolonged uptrend, I think, since late 20, I'm going to get rid of these moving averages for a second. I'm just going to draw a line because I think that's more illustrative, frankly. So since late 2022, and it seems to be just bouncing right around the bottom edge of this trend. So let's just take a quick peek. Draw your lines however you want, as my friend Carter Worth would often say. But can I get in there? All right. So you can take a look at that, judge for yourself. But looks to me like it has, it's at the bottom end of this range, bouncing off the uptrend line. And we have this upcoming catalyst. Options are not too terribly expensive. I'm just going to put in a moving average here. And I'm going to credit Carter Worth because I'd now use the 150-day moving average in general. And, the moving average is just basically an auto-drawing trend line of sorts as a smoothing mechanism. But take a look. I mean, it matches this trend line very closely. Bounced here, bounced there, and it could be bouncing here. Fundamentally, one of the greatest stories we've got going, massive free cash flow, massive free cash flow growth. We're looking at full year estimated free cash flow estimates of $70.2 billion. That's for the period that they're going to be reporting through the end of June. That's a huge increase from the round numbers, $60 billion that they generated last year. The growth rate looks like it's going to slow slightly, but still, we've got growth, top line growth higher than economic growth by a good margin, and much better than S&P growth by a good margin. We're talking about probably 2.5 times S&P growth. So, if you're looking for growth at a reasonable price, is this cheap? No. Is it reasonable given their recent operating history and what the street's expectations are? Yes. Are the options really expensive? No. So my thinking here is, and actually, well, let me make this point. So are the options really expensive in terms of what the implied move is? No. 4.7% or so implied versus a 4% average or slightly less. That's not crazy. But what is interesting is that the longer dated options in Microsoft are towards the upper end. Hugely expensive? Not really, but in the 81st percentile, so 3-month implied volatility right now is, in the 81st percentile looking back about a year or so. So definitely not cheap when you're looking at the longer dated options. Why do I bring this up? So one of the larger trades I saw today actually goes out further than that. It's December, and it was the 480 calls. And the 480 calls, by the way, so if we take a look at Microsoft, what we can see is that 480 is well away, not only from where the stock is now, but we're getting back up into levels that are higher than the all-time high that the stock achieved back earlier this month on the 5th. And those traded for, I think, 1105 at about 1020 this morning. And because the implied volatility is a little bit higher than average, because that would represent a new all-time high, I have a feeling that that 15 or 1600 lot that I saw, that could have been an institutional seller saying, look, if I get called out of the stock at an effective price of 490-ish from here, look, it's been a great year. You can't, how greedy can one be? I think that's the take. So I think the take for somebody with no position, that would generally be affected against a long stock position. So if somebody did not have an existing position, wanted to be bullish into earnings, was recognizing that dynamic that those longer dated options are not particularly cheap. As I said, 3-month options, 81st percentile. One way to play it going into earnings then, and actually I'm going to quickly do the same thing I did for Carvana. We're going to just take a quick peek at the term structure because we can see here, you can see that this is the implied volatility from a week ago. Was this a week ago? Yes, it was a week ago. Let's go back a month too. So I'm just going to go, so the red line is going to represent where options premia were a month ago versus where they are now. So you can sort of see this sort of higher options premiums. And if we go back some longer period of time, let's go back 3 months. This also helps give us some sense. So 3 months ago, this is where a 3-month option was, about 22 vol. Fast forward to today, and a 3-month option is nearly 26 vol. So, we're talking about a 4 vol click increase. Justifiable? Well, a couple things have happened. We've seen a big washout in IT stocks. We've seen a lot of stuff happening with the election. We've got September and October, which are historically more volatile months than we might normally experience in the June, July, August timeframe. So there's several reasons why something like that might take place. Nevertheless, we still have to recognize that because we have to also recognize that implied volatility, when some catalysts come and go, can drop back to those levels. The other thing is that rather like that institutional trader selling those 480s, I think Microsoft is, there's not going to be something that's going to blow the doors off too dramatically here. Microsoft, NVIDIA, companies of this size, the real thing that's going to really propel stocks to huge moves to the upside would be things like corporate actions such as takeovers, short squeezes, things like this. And also in the case of something like NVIDIA, where really everybody has some sense that the numbers are going to be blockbuster, but they just don't know how much. So you can get 130% year-on-year increases in sales and net income and things like that. That's not going to happen in Microsoft. So I think actually a better way to play it from the long side, and remember, one of the reasons I want to use options here too is that exactly what I was talking about with respect to that trend line. Two things about trend lines, and that is that it could bounce off of this. I'm just going to use the 150 again. Or it may not, right? It could violate it. This could be the moment it doesn't. Our expectation, we're going to play it from the long side, but that may not actually end up being the way things play out after earnings. Maybe we get a disappointment. So this is kind of a critical level we're at right here. So this is the reason that we want to use options. So options premiums are slightly elevated. We want to use the spread. We're kind of at a critical level here, and we have an identified catalyst in the form of earnings. So for all of these reasons, I think that if you're going to play Microsoft from the long side, the way I'd prefer to do that right now is with a long call spread. So I'm sure many of you are probably, or maybe some of you are thinking, you just said options premiums are elevated, why not sell them? They are elevated, but I'm not a huge proponent of selling options going into events, as I keep saying. So for anybody who's new here, just know that oftentimes when they're elevated, they are elevated for a reason. I like buy rights, I like covered calls, I like cash covered puts. All of these are good trades. There are 4 times a year, 4 earnings that you can just try to avoid. So avoid this one. And you can sell a little bit of options premium to offset it. So what's a way you could do this? I'm going to go out maybe to October or September here. Why don't we just take a look at this September one, just for the sake of argument. I don't know that you need to get this in the money call that it defaults to here, but something like this. 430, 475 call spread. 475, that would be above the all-time high. So you could say to yourself, do I really need to go that high? Yeah, maybe not. That would be an ambitious move for the stock from here. Average, I think the average 1-month move post earnings for Microsoft is in the neighborhood of 5-6%. So you could actually bring that in a little bit if you wanted. So something more like that, 430, 470, laying out $14 on a $430 stock for a call spread that encapsulates about 10% move from here. Okay, so this is, I have no idea whether we actually have any questions or feedback here, and the reason I have no idea is because this is not a normal time for us to have done this live stream, and so I'm just making sure I do it so that it is out there for people who want to watch, and maybe some people who would have normally expected it to come in around 4:15 are going to be able to find it here, but where did I put this? See if we have any input at all. Also, I just realized I neglected to post on Twitter that I was going to be doing this. That would be helpful, right? If you're going to change up the schedule, maybe let people know. So we got a couple people who managed to get the memo. Another quick and important point for those who want to follow these live streams. Here's a good reason to subscribe and get the notification bell so that you're actually alerted if we are doing one of these things as we are now at an irregular time. And by the way, this would actually be my preference. I think it's more actionable if we do these during the trading day so that we're actually looking at reasonably close to live prices rather than the day's closing prices. Things can change dramatically overnight. So one other quick reason why doing it intraday might be helpful. We can talk about events that are taking place right after the close that day or pre-open the following day. Something we don't have the luxury of doing if we do it at 4:15. I mean, we can still talk about it. You could still trade the stock, which is fine. And ultimately, by the way, I think that's one of the other things I want to point out is that you don't always have to do an options trade on these things. Sometimes straight equity trade is totally appropriate. Okay, so since I'm obviously getting greeted by a couple of the people that are watching, but I don't see any specific questions, we might as well just turn our attention really quickly to Meta as well. So this is interesting. I'm going to compare and contrast this one just a little bit with the Microsoft story. Not terrible valuation. Let's just take a look at that really quickly. So Full year earnings estimates of about 20 bucks. So that puts the stock 23 times full year earnings, 20 times next year-ish. These are very reasonable valuations for a company that's growing the top line like this. All very good. From growth at a reasonable price standpoint, so many of these stocks that have done really well, arguably, if we're just taking a look at how the company has performed over the course of the last couple of years and what the street's expectations are for the near future, definitely looks good. I am a little anxious, though. And why am I anxious? Principally, my anxiety comes from this. So we have a chart that doesn't look that dissimilar to Microsoft's, although at a much steeper angle, let's be honest. So let's just take a quick peek here. I'm going to put this trend line in here so we can get a look at it. You guys can let me know if you think this is helpful or not. So a little difficult to get, it looks to me like it may have already fallen below that uptrend line. So that's the first thing that concerns me a little bit. Let's just quickly take a look at the 150-day and see where it is relative to that. Once again, looks like we might be falling below that. And you combine that with the fact that on the most recent earnings result, the stock actually gapped lower, quite a bit lower. And so it filled that gap, which is fine. But clearly the street's expectations are a little bit different here. Technically, it doesn't seem to set up exactly the same way. So from a fundamental point of view, if they manage to just hit their numbers, very reasonably valued. But the price action suggests that some folks think that there's going to be something coming out that's disappointing. I'm not sure what that is, but I'm just highlighting this because even though this one's trading at a cheaper turn than Microsoft is, and it has we can't really dispute the fact that their operating results are pretty good, with one notable exception. Let me point this out very quickly. So the exception is, take a look at the free cash flow numbers. So year on year, the forecast is actually for a slight drop. Now, let's bear in mind that this is a company that is making substantial investments in AI. We've seen situations where they've made substantial investments in the past. So if you take a look at full year 2023, $43.8 billion in free cash flow versus $43.6 billion in free cash flow forecast for the full year for 2024. What's the big difference? It's the line right above that, CapEx. And we can see that the CapEx is going to be more than $10 billion higher. So they are making meaningful investments. Are those things going to pay off? That actually could be a reason for some of the weakness and the fact that it might be violating that uptrend line right now. And that is that some of the froth that's been built into the AI trade, people wondering whether these investments are really going to pay off. I think that's one of the concerns that people have, and that could be the reason that the stock might be dropping below that trend line. So I'm not going to recommend a trade here. If you hold the stock, I think that's fine, especially if it's a long-term holding, because to me, it still looks like one of the best growth at a reasonable price stocks out there, trading at a discount to the S&P and growing the top line at 15 to 20%, and the capacity to, we're looking at full year EPS growth of about 20%. Again, how does that compare to the S&P? That's 3x the growth rate at the same turn. Not that a fully diversified index like the S&P is comparable in terms of risk with a company like Meta, but these are good numbers, right? We can't deny that. So just something to think about. I'm going to take one last look, see if we have any questions or comments. which I fully recognize that there's a good chance that we do not, simply because of this this hour. I like this time, says Steve B. On the East Coast instead of leaving work. Yeah, I think I'm beginning to think that an intraday live stream makes more sense, assuming I have the ability to do it. And for those of you who don't know, up until the end of January, I was running a 40-act long-only equity fund. The fund did well. The business was miserable. It was not compliance costs and all that kind of stuff. It was not a good business to be in. But our performance was decent. But I don't think I want to go back to the 40-act business. But what that has done is it has freed me up. Intraday, I would not normally have been doing this, and I don't think I was even able to, from a compliance point of view, do anything like this before I stopped doing that 6 months ago. So yeah, maybe we will do this way. Okay, still holding on to the fast puts, decided to sell a higher strike put against it and turn lemons into lemonade, says Spicy Barbecue Tasty. Yeah, good idea. That's another important point, right? So we trade these catalysts, whether it's JB Hunt or Fastenal or Meta. You may or may not. I didn't propose a trade on it, but I wanted to offer things to think about in names that it's likely some of you are in. Microsoft, Carvana, which is probably not a name you're in. Maybe it is, maybe it isn't. But yeah, I think that's another important point. If you buy a call spread, for example, in Microsoft, and the stock trades lower, remember what I've said before, which is that I like cash covered puts, I like covered calls, that sort of thing. You might consider, if it goes the other way, selling cash covered puts or selling put spreads at what will then be identified as levels of support to offset the premium that you spent. So trade around those positions. You buy long calls and the stock runs, either roll up and out, roll up, or spread. These are all things you can do. Trade options positions dynamically if and when you can. Okay, so with that, it looks like I've chewed up my usual allotted time of about 45 minutes. And those of you who realize that we're going to be doing this live stream right now, for anybody who's watching this later, I apologize. Should have tweeted it out, or maybe you just don't have availability. But if this is something that's of interest to you, leave us comments, and we're going to talk about it. Oh, actually, you know what? I just remembered. There is one thing I wanted to show, because I was looking at this. So just so everybody realizes, if you make a comment or you have a question and you want to see something illustrated, and I don't, and I say, hey, I'm going to touch on it in a future show, I want to just talk really quickly about financials and rates, because that was something that came up and somebody said, oh, do you have some data on that? So here's an interesting thing. The tricky bit sometimes with doing something like this is that if you have something that has a functional limit, like interest rates can go to 0, for example, so there's kind of a functional limit. When you're trying to draw a relationship in terms of data, it's sometimes easier to illustrate it than it is to, say, throw out an R-square or some other metric which demonstrates the relationship between how a group of stocks might behave in response to things like changes in rates. But I realized I can actually illustrate that. So really, the rates that moved most dramatically recently was the short term. So I'm going to just focus on short-term rates here. And we're just going to take a look at this over time, because I think this does help illustrate the point I was trying to make before. Now I'm just going to get rid of that bottom, because this is a spread, and this bottom panel, so ignore that. The reason I'm just going to crush that is you would not be trading straight up one-for-one rates versus, say, XLF in this way. It's just to illustrate how rates and XLF behave in opposite ways. So what we have here is, in the white, this is 2-year interest rates. And what we have in orange is XLF. So that's the Financial Select Sector ETF. So that's probably a decent representation. Now, of course, that's going to incorporate all kinds of things, not just the money center banks, which is what we were talking about principally. We could substitute that if we want. Bearing in mind also that these banks, as I previously alluded to, they're not all exactly the same. They have different levels of duration in their held to maturity book. But as a general sense, if you want to sit there and say to yourself, okay, what is likely to benefit from lower rates, including things like real estate or financials or whatever, this is a kind of way to visualize that. So is it data, which is, I think, what you had asked for? Would be a little bit more complicated to give you some, concrete data on that, because, how are we going to determine what the metric is we're going to use to understand that relationship? But I think this does help illustrate it pretty meaningfully, right? So we can go back to, we'll just go back in time a little bit here. There's a pandemic plunge issue that takes place. So I think, this business here, you can see that they were huge beneficiaries as sort of things, came up here. But then as rates went up, these came down. There was a little brief moment here where they sort of traded together. This was kind of a risk on, risk off kind of a thing. But in general, you're going to sort of see that, that anti-correlation. And that, I think, was really the gist of the question that you were asking. So I hope that illustrating it in this way is helpful. If it's not a data table of numbers and things like that. And I'm going to start issuing a strategy and research note, sort of with a prosumer institutional focus sometime soon. We're going to figure out how to get that out there. But things like that are probably going to have more data of this sort and more trade ideas in them as well. But for those of you who tuned in, as always, I appreciate your time and interest. And I look forward to the next one, which will be on Wednesday. Will it be at 1:15 or 4:15? We'll wait for a little bit of feedback. And I'm going to wait for some of that feedback from the people who are going to watch the recording on this one. Let me know what your preferred time is, and we'll see if we can't make that work. Thanks for watching.